Hey guys, this is Justin from breakintocre.com, and in today's video what we're going to do is break down the four main commercial real estate product types and the pros and cons of each. So if you're looking to make your first commercial real estate investment and want to know which product type to choose, or you're looking to break into the industry for the first time and you want to know which product type that you're going to want to work in, make sure to stick around for this video. Now on this channel, we talk about real estate investing careers and real estate financial modeling and analysis. So if you're looking to break into the real estate investment industry for the first time, or you're looking to make your first commercial real estate investment, make sure to subscribe to this channel and hit that notification bell to be notified every time I release a new video. Now, when you're first getting into commercial real estate investing, you may hear investors talk about the four different food groups of commercial real estate deals. And essentially what these investors are talking about are the four main product types or different property types in the commercial real estate business. So by the end of this video, you'll know the four main product types in commercial real estate, how each operates differently, and where you might fit in the business, whether you're looking to land a job in the industry or looking to make your first commercial real estate investment. So let's start with perhaps one of the most popular product types out there, and that is multifamily. So for a multifamily property to be considered commercial, it needs to have 5 or more units. So this could be anything from a small 16-unit apartment building to a high-rise apartment tower with 1,000 or more units. Now, multifamily is one of the most sought-after product types to get into, especially for new investors, and it makes a lot of sense. Multifamily is one of the easiest product types to understand, and after all, everyone needs a place to live. So let's start out with some pros of multifamily real estate investing. So one of the biggest pros of investing in multifamily deals is that you're able to take advantage of positive economic shifts quickly. So with the short-term nature of multifamily leases, whether they're 6 months, 9 months, 12 months, or even 18 months, if the market that you own a deal in is experiencing significant rent growth on a short-term basis, usually within 12 to 18 months, you're going to be able to get all of your leases up to that market rate. So if your market is seeing 6% annual rent increases, usually you'll be able to capitalize on that 6% annual rent increase within that 12 to 18 month period. Now, another main benefit of multifamily investing is that multifamily properties are generally shielded from some of the big occupancy dips that you might see in another commercial real estate deal. So because many multifamily properties have 100, 200, 500 or more tenants, the diversity of that tenant base makes it much less drastic to your cash flows when 1 or 2 tenants move out of your building. So if you have a 200-unit apartment building and one person decides to vacate at the end of their lease, you're not scrambling to try and pay debt service because less than 1% of your tenant base has just vacated, and oftentimes you'll have a tenant right behind that tenant that's leaving looking to take that space. That said, one of the biggest cons of multifamily real estate investing is it's generally the most hands-on of all commercial real estate product types. So since you'll oftentimes have on-site property management teams, and especially if you're planning any sort of renovation at the property, you're going to have a lot of hands-on management and management of people to make sure that your business plan is going to go the way that you planned it. You'll also be responsible for how you actually want to design the renovation of that property for both the common areas and the interior design, which can be a costly and time-consuming process, especially when you're first starting out. Also, as quickly as rents can rise in multifamily, rents can also decrease. So if that same year of 6% increases suddenly becomes a year of 6% decreases, at the end of 12 to 18 months, you're not going to be protected from that rent drop in that market. All of that said, multifamily can be an extremely easy product type to understand, and if you're okay with the hands-on management, multifamily can be a great product type to get into. Now, the second major food group that you'll see is office buildings. So these can be anything from single tenant office buildings in a suburban setting to high-rise office buildings that you'd see in a major metropolitan area like New York, Chicago, or San Francisco. Now, in contrast to multifamily, office is one of the most difficult product types to really understand and has one of the highest risk-reward profiles of any commercial real estate product type. So as far as pros of office real estate investing, right off the bat, you can make a lot of money in a really short period of time if you find a good deal. So think about if you buy an office property that's 50% occupied, and then within 3 or 6 months, you're able to lease that remaining 50% of the office building and double that net operating income in the process. Since commercial real estate valuation is based off of that net operating income number, it's very possible to more than double the valuation of a deal like this in a 6, 12, or 18-month period. Now, another major pro of office investing is that if you're able to sign leases with high-quality credit tenants, you have a very secure way of being paid over a very long period of time. So think about an office building with Google as the main tenant. Google is a very strong credit company, and that landlord has a very high likelihood of Google making their payments on time and in full every single month. And especially if Google has signed a 10 or 15-year lease at a space, that's a lot of security for a really long time and a lot of revenue that you can depend on. That said, as far as cons are concerned, vacancy can spike really quickly at an office building, especially when you have a property that only has 4 or 5 tenants. So if you own an office property with 40,000 square feet of rentable space and you have 4 tenants each taking up 10,000 square feet, if one of those tenants vacates, you're automatically down to 75% occupancy. And at that point, depending on your leverage levels, you may actually be in a negative cash flow situation, which obviously isn't the scenario that you want to be in. Additionally, office cash flows tend to be extremely lumpy. And what that means is that you're going to have irregular spikes and drops in your cash flows to pay for things like tenant improvement allowances and leasing commissions as your office tenants vacate and as you sign leases with new tenants that expect a build out of their specific suite. Office is one of the most, if not the most, capital intensive product type in commercial real estate. So you'll want to make sure when you're going into an office deal that you budget for those capital costs and those vacancy periods that will inevitably come up in an office deal. That said, as far as overall management of a property management team, office is going to be much more hands-off than something like an apartment deal. So if you understand the business landscape and you can get comfortable with the tenants that you have in place, office can be a great investment vehicle. Now, the third major food group is retail properties. Now, this could be anything from a standalone retail shop like a bank or a drugstore, all the way up to a regional shopping center or a regional shopping mall. Now, obviously today, retail is undergoing a massive shift and retailers are needing to find ways to stay competitive and to continue to drive traffic to those retail centers. Now, with that said, many investors have been scared away from retail over the past few years, which actually presents a huge opportunity to retail investors who want to get into that space and are committed to figuring out how to make retail work. With any sort of innovation comes opportunity, and with any sort of change comes opportunity. And throughout history, we've seen real estate become repurposed based on the needs and wants of consumers, and retail will continue to shift in that way. So right now, there's a huge opportunity to take underperforming, well-located retail properties and transform them into something that is actually useful for consumers today. So while many regional shopping malls in the US are dying, those are also very well-located properties that have a lot of potential as long as the property is repositioned in a way that makes it useful for consumers today. Now, another major pro of retail properties is that oftentimes the leases on a retail property will be triple net expense reimbursement structures. And what that means is that the tenants are going to reimburse their pro rata share of the operating expenses back to that landlord. So in the case that you have 100% occupancy and you have all tenants with all triple net lease structures, as a landlord, that's going to protect you quite a bit from any sort of major spikes in operating expenses that you otherwise would have had to cover at the landlord level. Now, just like office properties, retail properties also tend to be much less management intensive. So if you're looking for more of a hands-off deal, retail could be a great fit for you. Now, a major con of retail is obviously what we mentioned earlier, that retail is changing very quickly. And with that, you may be buying an existing shopping center that may have some tenants that are dying and underperforming in that center. Now, with that said, that's a huge opportunity as well, because as those tenants vacate and as those tenants leave, you're going to have the opportunity to release those spaces to tenants that can actually activate your center and drive traffic to your center as well. Now, another con of retail is that these leases are generally very complex, probably the most complex of any commercial real estate product type. So you want to make sure that you understand retail leases inside and out, and oftentimes you'll want a qualified attorney in your corner to be able to decode some of this language in a retail lease, because these are savvy tenants, especially at the national credit level. So you want to make sure that you understand lease structures before you actually end up buying a deal. That said, overall, if you want to take advantage of a changing landscape and you're also willing to take the time to really understand retail leases, retail could be a great product type for you to get into. Now, the fourth major food group is industrial properties. So this could be anything from a warehouse all the way to a light or heavy manufacturing plant. Now today, one of the biggest pros of industrial is a huge beneficiary of the trend moving towards e-commerce. So with companies like Amazon needing additional distribution centers to get goods to people more quickly, industrial has benefited from that quite a bit. And with that, industrial rents have increased, the demand for industrial space has increased, and there have been many build-to-suit opportunities where tenants will actually approach developers, and developers will create spaces for those tenants on a custom basis. Now, another big benefit of industrial is that it's generally the most hands-off management of all commercial real estate product types. This is especially true if you only have one tenant and that tenant is just using that facility for storage. Oftentimes, you're not going to have the major capital improvements that you may have at a retail property or an office building or multifamily property. As I mentioned, there's also a big opportunity for build-to-suit product. So if you build brand new product for a company based on their own specifications, you have very little to change once that tenant is actually operating in the space. Now, a major con of industrial is the other side of the coin here when you only have one tenant. And that is, once that tenant vacates, you're at 0% occupancy. So this can happen really quick, and especially if you have debt on the property, you can get in a negative cash flow situation very, very quickly in industrial. Additionally, industrial is doing well right now because e-commerce is booming and the economy is doing well. But that said, when the economy slows and retail consumers are purchasing fewer goods, there's going to be less of a demand for industrial space. And because of that, industrial rents will decrease. With that said, if you want low management intensity and you can find a property with a long-term, strong credit tenant in place, industrial properties could be a great fit for you. So those are the four main food groups in commercial real estate investing and the pros and cons of each. Now, if you want to get more into the details on each of these product types and understand how the cash flows work in each of these product types as well, definitely check out my course, Commercial Real Estate Investing 101, where we'll go over all of these product types in detail. We'll also go over commercial real estate cash flows, valuation, and even more complex topics like JV agreements and waterfall structures. And if you want access to all Break Into CRE courses, all of our models, and additional support from me, make sure to check out Break Into CRE Academy, and I'll link that in the description as well. Thanks so much for watching, and I hope to see you in the next video.